My name is Dan Dorval, and I'm President and CEO of Dorval and Cherney Financial Advisors. I am an independent certified financial planner and author of my book, Financial Success for the Rest of Us, Reality-Based Financial Planning for Mainstream America.
Hi, my name is Leah Woodley. I'm an associate financial advisor with Dorval and Cherney Financial Advisors. Our conversations discuss what it means to do quality of life planning in all areas of your life.
Dan, I recently had a client who wanted to discuss active management and asked if we do active management. And our philosophy is a little bit different than other wealth advisors out there. We don't consider ourselves wealth advisors, but why don't you talk about our philosophy and our approach to investment management?
There's a lot of confusion about investing in general, and a lot of that is due to the way the industry, our industry, ends up portraying investments. Now, first off, I will remind all of our viewers that when we're talking about investments, they are simply tools to help you accomplish goals. So it is your goals that drive the investments. Yet most of our industry acts as if it's the investments that drive everything else. So they are marketing the idea that they know what the future will hold. I'm going to sell you the best investment, or I'm selling past performance as if it's going to continue to be that way in the future. So there's a lot of confusion about this. There's a lot of noise about this. And the reason it happens is a lot of our industry markets investments as if they're adding value through the investments. In many cases, they are not. So in our case, it's the planning and the advice that really has the greatest value to the people we help. And then the investments are one puzzle piece in implementing that greater plan based on your goals and objectives and things you're trying to accomplish. So when we talk about like active management versus passive management, the way we communicate that confuses people even a little bit more, because active management traditionally is you are outsourcing investments to some sort of an active fund manager. Now, this is not the advisor. This is an outside investment manager. So they're outsourcing the investments. That manager is then picking and choosing, expressing judgment on investments. They might be very good at their job. They may not be very good at their job. But the challenge of active management traditionally are fees. So when they have higher fees associated with paying for research and the teams associated with putting together these funds, most actively managed funds, at least data has shown, they do not overcome their fees and offer significant value to their investors. So we look at that and we say, okay, there are some, and we actually use American Funds for some of our clients. American Funds is one actively managed fund company that has traditionally shown they add value through their process. Now, they have very low fees for active management, but they add value through the investment process. So we do use them in certain situations. However, most of our client portfolios, we don't use American funds. We actually use exchange traded funds, and they are passive index funds in our Schwab portfolios. So Schwab being our primary custodian. But when we use these passive funds, what we're getting is very, very low cost. So we have less of a hurdle to overcome in that regard. But then our process is an active process. So we've eliminated the fees associated with an active outside investment manager, but we are exerting that active management process through a couple of different functions. One being rebalancing, which is something most people don't do. The second thing is with our portfolio construction. So we have a proprietary process where, depending on primarily valuation of the market, so if the market is historically at higher values, we will then compose our asset allocation from different types of passive funds. So we've incorporated what are called factor-based funds. Now, most people have no idea what a factor-based fund is, which is exactly why you use an advisor to do these things, okay? You don't have to incorporate factor, index funds, but what we do is, when markets are historically expensive, we start to favor certain characteristics. Those characteristics tend to be low volatility. They tend to be quality, meaning that these are companies that historically have good dividends, they have good earnings, they can weather the storm of a recession. And so we'll start to overweight those factors. If the market is very low historical price, maybe the economy's in pretty good shape, we'll start to overweight other factors. So our approach is very unique in that we're coupling the very low cost of passive index funds with an active management process that incorporates things like valuation and other proprietary characteristics that we favor.
Wow, thank you for sharing that. And I think when you were discussing the active management being outsourced, I think that's something that a lot of people may not be aware of, even though, of course, it's in disclosure documents that they receive. Sometimes people don't read those documents, but that is important to note as well. Why don't you talk about the role of sequence of return risk when you're considering um, what to do with these investments?
So one of the biggest things for our viewers is, what phase of investing are you in? So if you're a younger person, maybe this is a retirement account, you got a long time until retirement, we call you an accumulation phase investor. In that scenario, you're almost always going to be utilizing a 100% stock portfolio for that specific goal. And now what happens is, when you're accumulating, you're putting money in. So like your 401k, you're putting money in every pay period. And so sequence of returns don't matter. If the market goes down, you're buying, eventually it comes back up. If the market goes down, you're still buying, eventually, like everything that we look at, sequence of returns during the accumulation phase, not a big deal. Okay. Now, as you get closer to needing that money, so in this scenario, let's say it's a viewer who is getting either closer to retirement or they're in retirement. Now we have a different perspective, because when I am no longer putting money in and I'm actually taking money out, or at least thinking about taking money out soon, now this sequence of returns matters big time. So what that means is, if I happen to suffer a very severe decline right at the beginning of the time I need that money. So let's say I just retired, market goes down substantially. That sequence of returns, that being unlucky, means that if I'm not managing for that process, I can devastate my portfolio, because I'm taking out money and going down at the same time. I can get so far down that when things eventually come back, and they do come back, I'm still taking out money. Now my withdrawals are too big. I can't overcome that. And so I am permanently now in an unsustainable income stream. So sequence of returns is a massive risk associated with retirement portfolios and generating income. Now, the way we mitigate that process, we have a proprietary management process. This is that whole active versus passive. We're using passive index funds for the portfolio construction, but that process of taking income, we are actively managing that process. So let's say the market goes down, you're taking out income. We're going to be pulling from specific, parts of the fixed income portfolio, the bond portfolio, in order to then allow the stocks to have time to come back. So the bonds buy time for your stocks to come back. If stocks happen to be up when we're pulling income, now we can harvest gains from those stocks, rebalance the portfolio, keep the income going, and reduce the risk of a sequence of returns, issue. So this is something where, if somebody's close to retirement or they're in retirement, the whole process of managing investments is dramatically more important. And that's when an advisor adds the greatest amount of value on the investment side.
Yes, that's what I was just going to say. That does take an advisor to look at the big picture and to look at all the little intricacies involved with each stage of planning for retirement and accumulating wealth and things like that. So Thank you for sharing that. What pros and cons would you say there are to each one, active versus passive?
So, it really depends because, to be honest, on the pro side, I'm going to say that the biggest pro is to the manager.
Yeah.
There are a lot of people who are selling investments. They might even be like very sophisticated hedge funds. It might be mutual funds, whatever it is. But these people make a lot of money.
Hmm.
And so if they can market to you and convince you that they add value through that actively managed process, they become quite wealthy in many cases. Now they might provide significant returns, in exchange for those fees. And in that scenario, they're earning their fees. But most people, at least historically, do not overcome those fees with active management. Now, for most of us, and particularly men, we find comfort in active management because we feel like somebody doing something is better than the perception of a passive fund where we are doing nothing.
Yeah.
And so that feeling, that perception has value specifically to a lot of men. Now, the passive side, the big pro to that are low costs. You're not paying for, a hedge fund manager, you're not paying for a mutual fund manager, you're just paying for a financial advisor. But as
Mhm.
far as, that's one of the biggest pros to that approach. Now, the biggest con to passive indexing is you have massive volatility. I mean,
Yeah.
the S&P 500 right now, seven stocks make up a very large percentage of a conventional S&P 500 index fund. And so you have concentrated risk that you just don't think you have because you own a lot of
Mhm.
stocks, but they are market weighted indexes. And so you have a lot of potential volatility. If the market goes down, 50% over the next couple of years, which we have had two 50% declines, in the last 25 years. So it's possible, right? If that
Mhm.
were to happen, you're going down 50% on the S&P 500 if that's what actually has happened.
Yeah.
So there's no mitigating that volatility. And that becomes a massive, massive problem for people who are, again, close to retirement or in retirement. It could now jeopardize your potential goals.
Yeah. Thank you for clarifying that. So, what would you say to the person that is on the ledge who, may think that they need active management, but, you know, they instead need to be focused on their goals? What would you say to that person?
Well, a lot of times what we'll see is people chase performance.
Yeah.
And so they'll look backwards with the
Mhm.
value of hindsight. They will say, hey, this particular fund has done better than my portfolio. Or, we see clients do that to us sometimes. They have a
Mhm.
diversified portfolio. They'll come to us and they'll say, hey, the S&P 500 had a great year last year and they outperformed you. And
Mhm.
we have to explain to them, you're comparing apples and oranges here. There are different pros and cons to these types of portfolios. But
Yeah.
if you want the S&P 500 index, just acknowledge the fact that yes, maybe last year was very good, but you're
Mhm.
going to have a lot of volatility. So it's not just performance with the value of hindsight. We can't look backwards and say this fund has been the best fund for the last 10 years. Therefore, it'll be the best fund for the next 10 years. Again, studies have shown that the best performing investments for the last 10 years are almost never the best performing investments for the next 10 years. It's
Yeah.
very rare. So we again feel like looking at that data gives us some advantage in looking forward, but in reality that's a fool's errand. It doesn't
Mhm.
work. And so again, having that conversation so that people understand picking investments isn't as easy as just look at the best performer for the last 1 year or 3 years or 5 years or 10 years. It doesn't work that way.
Yeah. Well, thank you so much for the information you shared today. Is there anything else you would like to add?
Well, I think one of the things is if you have an advisor or you're talking to advisors, and that advisor is telling you that, hey, you should work with me because my investment approach has, out returned other investment approaches over some period of time. Even if they can show you that, it is almost never the reason to work with a financial advisor. It just, that is something that's very attractive, again, to many men more than women, but it might be a very attractive appeal. It's a good marketing approach, but it is not a very good approach to financial planning and advice.
You are correct with that. And that's why we do quality of life planning. Well, thank you so much. And until next time, have a good one.
Thanks, Leah.
Thank you.